Hey, I'm Lee Walsh. We recently did a guest presentation for the R.E.I.M group in Birmingham, Alabama on their meetup. It's on real estate investing 2022. A lot's happened in the past 18 to 24 months. Nothing is the same. What does 2022 have in store for real estate? We're going to cover flipping, renovating, appreciation, mortgage rates, rental rates, and a few other things I think you'll find really informative. Where are we going in 2022? Well, watch this webinar and I think you'll have a better idea. I have worked in just about everything from starting as a mortgage processor in a company I owned because I wasn't licensed and I wasn't allowed to originate, even though I was half owner. I was the company processor, to a loan officer, to into management. I've worked as an underwriter, managed teams of underwriters. I was fortunate to have founded or co-founded several national companies and worked in senior management. Probably the thing I'm most proud of is the senior management at a company called Transland Financial here in Maitland, Florida. And we were the largest privately held construction lender in the country. We pioneered a lot of programs with HUD. And that's really where I learned renovation lending and a lot about alternative types of lending. We founded R.E.I.M Mortgage 4 years ago. We are now active in over 40 states. And primarily what we do is investment property lending, whether short-term renovation or bridge lending or long-term 30-year financing for 1 to 4 or 5 unit plus. And that's who R.E.I.M Mortgage is. In this presentation, my compliance attorney requires me to say this. The information we're providing in this presentation and accompanying materials, things we make available through our website, in person or in webinars, is for informational purposes only. Should not be considered legal or financial advice. You should consult with an attorney or other professional to determine what may be best for your individual needs. Your use of this information is at your own risk. With that said, let me ask a question here. There's not a whole lot of us. We can either do it in chat or you can just speak up. But how do you feel about the real estate market going into 2022? One of three answers. Are you excited, worried, or not sure? You know, we've had a couple of years of just crazy turmoil. I know people that say it's the best it's ever been, and I know people that say it's been terrible. And I know plenty of people that say that about looking forward, too.
I said not sure.
Not
We've
sure.
had
I don't know if I can.
We've had so much ups and downs. Don't know what we have in the near future.
I think everybody is that way. And, you know, the most we can do when that happens is let's look back historically at what has happened and what has happened in the last couple of years and then historically. And it might give a good indication of where we're going with this going into the new year. You know, so much has happened in that period, in the last 24 months. What we want to talk about first here is flipping and renovating. And we're going to cover 4 or 5 key areas, but flipping and renovating first. And I'm going to first go to a slide on the left. When I first started doing webinars, and well, it really wasn't even a webinar, it was live in person. We rented here in Orlando, there's a town called Winter Park, and we used to rent out the Winter Park Library and do presentations on fix and flip financing to help new flippers understand how the financing mechanism works. And one of the first slides we showed was the home flipping profit trends on the left, and I'll zoom in on this in a minute. And that covered 20 years, almost 20 years, from 2020 to 2019. And then I just looked up the same chart today to see where it is. And we'll zoom in on that first to show you, you know, several years ago, this is home flipping profit trends. The blue is gross profit. And per quarter. The green is gross return on investment. And so when you look back at 2019, flippers were making about 50% gross profit, high 30s in return on investment, which is pretty good. Although it has been declining, if you look at that, it started declining several years before that. I think that is pretty much a high. Then when you go over to the right and you look at 2021, it's continued to decline. Although gross profits have increased, your return on those gross profits has decreased, which means you got to spend more money to make money. The amount of money you're making for what you're spending is decreasing. I think probably the one of the more important stats to look at is let's look at it again over that 20-year period, January 2000 and January 2021. And if you see the blue line that I've done there at about 45,000 on the left, and which equals about 35% on the right, that's just tracking the current gross return on investment and showing you historically where that measures up to where we are today. And the blue again is your gross profit on flipping. We were at record highs on gross profit, and for a while, record highs on the return on investment, historically over 20 years. And so, if you look at the chart, it goes up, it goes down. There's highs, there's lows. So there was a pretty good run, just escalating profit over and over, increasing profit. So I think when you look at the median line there of where we are today running across, we're still in pretty good shape. It just looks so ominous when you zoom in on it for a couple of quarters and zero in on one stat as opposed to looking at the bigger picture. Could it be better? Yeah, it could stop going down. But still, we're in good shape, I think. That's the question there. Are we still in good territory? And I think we are, as long as it doesn't just keep dropping. If your average profit right now, your return on investment is 35% of what you put in, that's a darn good return on investment. Sure, you could complain that it's been over 50. 35 is not a bad number to walk away with. So next, let's talk about appreciation, property appreciation. That's the number that has, that is driving the real estate industry today. It's the biggest driver, real estate appreciation. And it's just an increase in the value of an asset over time. Some of the numbers I'm going to go over here don't always match up because one will be comparing July to July, one will be comparing December to December. But I think what you'll see is overall, no matter how you slice it up, there's been huge increases in appreciation. And I think the big question is what's it going to keep doing, right? So this is looking at July 2021, year over year from 2020. 3 different indexes, all showing around 19% increase year over year, July over July in appreciation. I mean, that is just tremendous. I think that was the peak for the year. This year was July year over year. One of the people I follow is a guy named Bill McBride, who puts out a financial blog called Calculated Risk. And his impression was that 19.7 is about as close to a peak as we're going to get. We're going to see increases slow as we go into the end of this year and going into next year. I think everybody would probably agree with that is, if we had another year of appreciation like we just went through, we would be in a huge inflationary recession. It would just crash everything. And I don't think the market is going there for a couple of reasons. We'll cover some of them. We don't have the inventory, right? That's probably one of the biggest reasons. This is where everybody is thinking it's going to go over the next 5 years. 2021 over 2020 is going to be about a 12% appreciation overall when you average it out. Nationwide, we're going to see higher and lower ones at different parts of the country. Hot spots and cold spots averaged out around 12%. Next year, around 6% is where people think it's going to go. And then a slow, gradual getting back to normal appreciation. And I know people that are getting depressed about that. I think, when you look at it over a 5-year period, what most people don't take into effect is, which is the real power of real estate, right? Compounding your interest. Going from a soft decline to a normal appreciation, I think will keep our real estate market thriving. When you look at how compounding works, compounding interest is just the addition of interest to the principal and then paying interest again, which is just interest on interest, right? But that's what real estate does. Real estate is compounded interest on the value on top of value. If your home goes up 3% this year, now it's going to be that 103% times whatever percent it goes up next year. I know I'm preaching to the choir here. I have a bunch of real estate people here, but a lot of people lose sight of that compounding. So this is where just about every stat I can pull, this is a combination of stats that show if we're at that 11.74 for the year for 2021, it finishes around 12. And the annual average through the next 4 to 5 years
is a 5.7. That's a compounded cumulative interest increase of 31.8%. That represents the expected increase in home values thanks to compounded appreciation. And so look where that would take you, right? If you're sitting on a piece of property that's worth 350 today, or it was in January, everything says based on that appreciation we just looked at, that we're going to have a property in about 5 years worth, over $460,000. And that's just getting back to normal appreciation. But that's saying that we're not going to have another wildcat year ahead of us. That's saying it's going to taper down, and over a period of 18 to 24, 36 months, the appreciation increase is going to level out. And I think we'll see as we talk about inventory a bit later, it's exactly what has to happen just because we don't have the inventory. I would call that acceptable appreciation. I think in any market, if you could have that kind of appreciation over that period of time, if you're sitting on $110,000 or $12,000 worth of real estate, you're sitting on $350,000 worth of real estate, and then 5 years from now, it's going to be worth $460 just by normal appreciation. That's a pretty good lick right there. So mortgage rates. Mortgage rates is my favorite topic. My industry everybody has an opinion about where it's going. I think the people that are the best at predicting where it's going are what I call the big four: Fannie Mae, Freddie Mac, the MBA, and NAR. All of them follow rates closely. Now I'm talking here conventional mortgage rates. These are the rates that all four of these track and follow. And usually alternative rates are going to be, 1.5% to a couple of percent higher. But this is where they're tracking and what they believe it's going to go to. When you look at it, got that first column is the quarters going into next year, third quarter. Then you've got what Freddie Mac thinks it's going to happen, Fannie Mae, MBA, NAR, and then the last column is an average each quarter for them. Generally in this kind of stuff, the averages tend to true out more than anything. And I think the one outlier here is Fannie Mae. If you look at Fannie's prediction versus everybody else, they are as optimistic as you can get. They're painting a very rosy picture. Right now, they're saying rates are going to stay around 2.9. We just closed the 2.95. We just closed the 3.1. Rates are right around that area and that Fannie Mae range, but I don't believe they're going to stay that way through the year. And also the other big three there agree. When you look at them, if you discount out Fannie Mae, you have more like end of next year, you have more like a 3.7, 3.75 rate is where we're going. So we're definitely going to go up. How much it's going to go up? This is where everybody's predicting. I think the average is going to be a little wrong because of Fannie Mae. But what happens if it goes higher? Can we stand a 4% interest rate in where we sit today? I think that's the big question everybody's looking at is how high will rates go? At what point will they start to kill everything and crash everything? I hear a lot of people say that 4% is the death note, pounding the nail in the coffin, and that'll be it. And, I'm not so sure about that. I know 2.9 and 3.125 is a wonderful rate, and it helps a lot more people get into homes. But prices are going up, right? I mean, they just are. And so if rates did go up to the 4%, and although all the experts, and I'm far from an expert, agree with all the experts that it's going to be in the mid to upper threes is where rates are going. But if it goes to 4, where is it going to be? This is looking back from January 1976, the interest rates. January of 76, it looks like rates were about 9%, right? 2021, we're hovering around 3%. But I drew the line there at 4% to give you an idea where 4% would put us historically. We're still in historic rates, hovering around 4. So, if rates stay under 4, stay in the high 3s, I think that'll be great. Are you seeing those kind of rates on conventional lending in your market? I know we've got at least 3-4 realtors on the call. Are you seeing those Fannie Mae rates in the low threes in your market still?
I think so. Yeah. Yeah.
Okay.
Low threes.
Yeah.
Mhm.
And I really think you see there where we go if it goes to 4. It's higher, obviously. Bigger payments, people can buy a little less home. But historically, it is not the end of the world. It's gone much higher. My first home is where you see the highest spike there. That's when I bought my very first home. That's my introduction to real estate. Even though my mother was a real estate investor and had 40 properties, I bought in at the highest possible point in the history of the market.
18%, 19%, right?
Yeah, 18% was I think it was 17.99. It was with World Savings. It was a negative amortized ARM. And I was darn glad to buy the house. It was my very first home on a VA loan. So, I mean, you see where it is now, the rates are going to go up a little bit. I don't think in the next near future that we're going to go over 4. You might see it hit 4 1/8, 4 1/4 once in a while, but I think you're going to see it more living below 4 in going into the next year. And you'll see a couple of other reasons here why you're going to see that. Here's something I know everybody cares about: rental rates. Where are they going? That's probably the easiest thing to answer, right? Up.
Up, yeah.
They're going up.
Initially.
And a lot of people didn't think about this. Mortgage rates, they're volatile. They go up daily. Home prices, volatile. They go up to whatever the market bears. But rental rates are tied to long-term contracts. And so they can't go up that rapidly. So there's always a lag between rental rates going up or down and home prices and mortgage rates going up and down. So, and we all know what's happened to home prices. So here's where what's happening to rental rates. This is a crazy graph. If you look at that spike, single family homes, the average up until now, the highest has been right around 6%. Way back in 2005 was the highest spike in the history. We've had single family homes hit 10% increase in rate. That's huge overall. Now you got to remember, this is nationwide overall. So there's going to be areas that will easily be double that in percentages. This is a national average. So those spikes are crazy. The orange spike is single family attached, which would be a townhome, really, or a condo, and then a single family detached. Attached are not rising as much, but they're still getting into record territory. We all know that, right? There's nothing new here about this. It's just rents are now starting to catch up with home price increases and other things that are, on the increases. But this one surprised me when I looked it up. We have housing shortages. This is housing under construction. Red is 1 unit, blue is 2+ units, and it's looking at it since 1970. So a 50-year look of where we are as a country on housing starts. And we have been in a trough lately, right? You look from 2007, 9, it just tanked and we stayed down there. And we're still nowhere near at levels of where we could be to address the problems we have right now with housing. Whatever factors made this happen, this is the reason we have the problems we're facing today in housing. We have no housing because we didn't build any housing. That's a sad fact. So, I think it's going to take us a while to build our way out of this. You see, it has been going up and going up and going up, but it's a slow progression. It's not going to happen overnight. I hope that continues to go up. If both of those continue to rise and continue to have an upward trend, it'll really help fix our housing problem. It'll help stop the rapid appreciation of the existing housing. It'll help address the rising rent rates because there won't be such a housing shortage. I'm not sure how much the recent Zillow debacle is going to impact us all. I don't think very much. I think they have enough money to dole out those homes on a slow basis and not just flood the market with homes that they're going to crash and sell at a loss. I think they have enough funds to do that. It looks like they cut 25% of their work staff and are going to try to weather the storm there. That was one of the dumber moves, right? Just buy everything.
Yeah, really.
And let me I don't know about your industry, but on the mortgage side, I don't know about the real estate side, but on the mortgage side, a couple of years ago, we considered Zillow to be our biggest enemy because they were moving into mortgages, they're moving into real estate, and they started buying up houses. And everybody thought, everybody in the mortgage business thought, quit complaining about Rocket Mortgage. You need to worry about Zillow.
Yeah, I think it's the same for us in real estate as well.
Yeah, and this is going to set them back a while. Doesn't mean they're done. I don't think they're done, but it's going to set their plan to take over the world back a little bit.
Yeah.
And so let me ask everybody. There's not. After going through the stats I just went through, and going over, looking at it, renovation, appreciation, mortgage rates, rental rates, home building ratios. How do you feel about the real estate market?
For me, I'm excited. I think a lot of good things is happening for us real estate investors, especially on the rental side. What about everyone else?
I agree. I think it's really looking good on the rental side, but on the buying side, it still looks like it's going to be very competitive. Well, somewhat competitive, I'll say that. So I'm still not sure on the buying side.
We could use a little relief there, right? I mean, the prices could ease up a little bit. It would change everybody's world a little bit.
It would.
Yeah.
And that's really, I think, there's also a stat I didn't use that showed that month over month, every month, more and more homes are coming on the market. And I don't know, you may be seeing that in your real estate reports also, that, we are no longer in the trough on homes on the market availability. Little by little, percentage by percentage, more and more homes are coming on the market slowly. And this is we're going into what your slow season is real estate sales, right? Slower season.
Mm-hmm.
So, we'll see it slow down anyhow. Everything slows down going into November, December. As long as I've been in the mortgage business, I have seen business really slow down about December 10th. And December 10th to about January 10th, we mostly spend that on housekeeping issues inside the company and I think everything slows down, which is a good thing. You'll see rates go up a little bit, because everybody's trying to slow down. Mortgage companies are trying to slow their pipelines down to close them out. So if you see rates go up in December, as long as I've been in the business, rates have gone up in December. And don't look at it as an indicator that, things are going to keep going up. It's standard to go up 0.75% quickly. When the business drops, lenders say, okay, let's try to shut it down as much as we can so that we can get the end of the year cleaned up. But overall, appreciation, mortgage rates, rental rates. Do we have any flippers on the call? Anybody that does renovation and flipping?
Oh, I mean, I do flips, but I think we have some people on the call. I know one or two here have flipped a house, but I don't want to point them out if they.
Yeah, I hear you. A lot of the financing that we do is flip and renovation financing, and what we're seeing overall is flippers are moving, doing two things. They're either finding untapped markets, which is getting harder and harder. Before I started this company 4 years ago, I ran a Miami-based lender, and we dealt with a lot of flippers in Miami. That's like it seems like that's where it started for some points. And I remember 4 or 5 years ago, flippers in Miami telling me they were moving to Alabama to flip. They were done with Miami. So everybody's looking for fertile markets where to do flipping. But then, there's also in your own markets, what we see is people, if they're not doing that, if they're not jumping outside of their comfort areas to buy properties, they're moving up in value in properties and using financing to do that leverage. So they're using financial leverage more because they're having to move up into a higher level of property. So we're seeing that a lot. Some flippers that we've been working with that were in the mid 100 ranges are now in the mid 200 ranges in what they're in the projects they're working on.
Right.
And what they're trying to do is increase their return on investment on every deal. Property appreciation is, in a way, is hurting them in that respect when you buy. Even if you're buying rental property, maybe on the BRRRR method, if you're buying, repairing, renting, and repeating, that at least you're using long-term appreciation charts, and short-term ups and downs aren't going to affect you as much in your plan. And so I think for those people that are buying distressed properties, renovating and stabilizing and renting, and then keeping them, I think you're going to see more renovators doing that as opposed to flipping, because that property appreciation now is working for you. Anybody have any questions about anything we've gone over or anything that we didn't cover that you wanted us to cover?
Lee, I do have a question. I think it's about, looking forward for a real estate market and not having enough inventory for the days to come.
Yeah.
What do you think about, the moratorium has been lifted, all the forbearance, evictions, and things like that. So I know we had somebody from auction.com. They were saying that they had I think she said 1.6 million houses in backlog that they could not do anything with because, they couldn't foreclose on the property. So now that's not there anymore. What do you think about the foreclosure market?
Well, I've seen a lot of stuff on that on the mortgage side. And the talk is that when you look at the percentage of equity that people are sitting on, no matter whether they're behind on their mortgage or not, they're sitting on record equity. And so I think those numbers will be toned down because of the amount of people that can refinance out of their problem or sell and walk away with some money. I think that'll tone down the numbers that would have happened if that wasn't the case. When we had the real estate crash, nobody had any equity, right? Nobody had equity. Everybody was refinancing their equity as fast as they could do it. One of the differences right now between now and the crash is people are sitting on record equity right now. So I think you'll see that if that wasn't in place, if that record equity wasn't there, I think exactly what you just said would cause a real problem. But I think the numbers tell out that at least 40 to 60% of those people will be able to either refinance or sell their way out of their problem.
Okay.
Does that make sense? At first I thought, well, I didn't even think of that.
Yeah, it does make sense.
Yeah, until I saw the equity report.
Right. Yeah.
Because everything you see says refinances are dead. Refinances aren't dead. They're just not at record levels. That's all. Just like home sales are tapering off a little bit. So everybody's saying home sales are dead. They're not. There's some people are sitting on so much equity right now. It's crazy. Which you'll see a lot of people doing renovation loans to upgrade their properties. You'll see people upgrading to sell, right? And so a lot of that can work to everybody's advantage. You could find people that just don't want to take the time to upgrade. They know it's upgraded, their home's falling apart, and they want to find somebody like you to take it over and let you worry about the upgrade and split the profits with them, right?
Right. Yeah.
Those people are out there. I think the real message is no matter what market we're in, no matter what it looks like, there is business. You just have to, pick your business and go for it. Don't let all the naysayers distract you on where things are going. Renovation return on investment is still at record highs. Appreciation, although it's toning down, is still at really great, attractive levels. And mortgage rates are going to stay relatively low. They're going to go up a bit, but not much. And rental rates, man, I wish I had 10 rental properties right now. And so, yeah, I think 2022 is going to be an amazing year.
Yes, I have a question. Can you hear me?
Yeah, yeah.
Yes, I wanted to, you were talking about the rental versus flipping, and I just went full time last month with this, and I got I have one house that I'm going to renovate, but I also have another one under contract. It's a duplex in Florence, Alabama. I'm in Alabama. And I'm just kind of worried about, one thing I was going to do was try to buy and hold this duplex. But then again, I might wholesale it. I'm just kind of stuck between which way to go. Am I going to wholesale it? Am I going to buy and hold it? Am I going to try to fix and just flip this? What kind of advice could you give to someone like me to kind of be able to make a more decisive decision?
It's a good question, and we come across this a lot, and it's a valid question. Is part of it is what your plan is for the next 5 to 10 years. Are you going to be in a renovation flipping business as a business you're going to do, or are you doing this to get the experience and maybe build some equity and build yourself into some real estate? I would say that the best plan is kind of go down both roads at the same time, and what percentage should be up to what works for you. The BRRRR method, what most people tell you, even if you're flipping, is to, buy, renovate, and sell, buy, renovate, and sell, and buy, renovate, and rent. Some combination of that, whatever works for you. It's got to be how much capital you have and how much you're making on the flip. But I would say bottom line, with the way appreciation is going over the next 5 to 6 to 7 years, I would try to hold on to some of them, because you're building that appreciation. Somebody else is paying down that home for you, and you're building assets.
Okay.
I wouldn't, how many you keep that you do is really up to your plan and your need, but I would try to keep some of them because of the appreciation we're going to be going through.
Okay. All right.
Does that help? I hope that helps.
Yeah, that's kind of the road that I was going on. I just didn't know if I was being wishy-washy by, going back and forth, so yeah.
I don't think so. And I think everybody on the call, anybody with more experience would tell you that you have to be flexible. Sometimes you're going to focus more on one thing, or another time focus on another, based on the market. I've seen so many changes over the years, and what it does is it changes what I have to focus on for my business to do well. And your business is the same. And so you'll see that. You can call it shifting sands sometimes, but it is. I think holding right now some real estate would make sense. Manisha, Tanya, how do you feel about that?
Oh yeah, that's Lee. That's absolutely, and Wiley, what Lee said is absolutely true. And one thing that we talk about in our investment class is when you have like rental properties, right? We talk about the internal rate of return. You talked about appreciation. Then when in addition to that, when your tenant are paying down the debt, you're building up equity as well. Right. And then your property value, the mortgage that you have is not going to change. So you're really building up your property value in so many different ways. And appreciation, like you said, is 35%. And then, when you add on that equity pay down to it, that even becomes higher and higher. That rate even becomes higher and higher. And when your rental rates go up, like it's going right now, that adds on top of it as well.
And I think that opportunity on rental rates is going to be there for a while. When you look at those home starts, it's going to be a while. Yes.
right? As long as there's shortage of housing in the market, as long as, you know, buyers are not finding properties and they're having to resort to rents, the rental rates are just going to go up.
Thank you.
Yeah. Anyone else has any other questions or any comments or anything that you guys want to talk about?
Hope this information helps and gave you maybe a little more perspective on all this.
I think it did. I know it did to me because, you know, we're always talking about what is the foreclosure going to do to the market? What is the interest rate going to do to the market? What is the rental rates going to be, or things like that. So I think it puts a lot of things in perspective for us real estate investors. That's definitely for sure. Lee, I do have a question for you though.
Yes.
So I know you do, you finance fix and flip deals and you finance buy and hold deals,
Yes.
right?
Yes.
So how does that look like maybe for a first timer, or, you know, who's done it a few times, or things
Sure.
like that?
We have what we call entry level for both short term and long term. On the short term, on a renovation loan, we'll generally cover 80% of the purchase and 90 to 100% of the renovation. And as the person gets more experience, 3-4 deals under their belt, then we'll increase how much will go against the purchase to 90%, and the cover 100% of the renovations. And the rate will go from in the 10, 11 range down to the 8, 9 range. So the more experience you have, the better terms you get and the better financing you get. Long term, it's looking pretty good right now. We're doing, I think the best program we have is purchase 20% down. It is interest only for 10 years. And then it converts to a 30-year mortgage.
Wow.
So on rental property, you know, you're talking cash flow is king. Nobody on rental property keeps a mortgage 10 years. You know, you're going to refinance or sell. You're either going to gain so much equity or rates have gotten so low, some reason it's going to make you refinance. We love this interest only program. 10 years interest only. So it really increases your cash flow. It also lets you control your payment. If you want to pay additional principal, you can, but you don't have to. So if you look at that over a 5, 6 year, 10-year period, what that changes in your cash flow, money today versus equity you gain tomorrow with your small principal payment on a 30-year mortgage. I think for investors, the 10-year interest only makes the most sense.
Yeah, that's a great program.
That one, we just look at we don't look at W-2s, we don't look at pay stubs, we look at credit. You got to have about a 660 score for that program, 20% down, and the property just has to debt service. And by that, we mean the rent has to be equal to or greater than the principal in what the interest only payment and taxes and insurance payment would be, which is, that's impossible not to meet that. I mean, just impossible. So everybody on that perspective would qualify. We're starting, we just got that new loan in about 15 days ago, and we pushed out to some of our old clients who are investors, current clients, and people we've done loan for before. It's increased our pipeline with that program. You know, because it lowers your payment. So I think that's going to be the hot new product for the year going into 2022.
That's great. That's unheard of.
Let me ask you, on your market, do you have much foreign national investment?
Foreign national? Oh yeah, we're starting to have foreign investments coming into Birmingham. I think all these foreign investments are leaving big cities and coming to Birmingham.
Well, you know, I have done 3 workshops for Canadian investors. This is a workshop in Canada that I was a guest speaker on. I've done 3 of them. And all of them ask me areas, where do you think is a good place for us to buy? And I always tell them Alabama.
Oh, yeah.
I said, look, I've been doing business in Alabama since the 90s in the mortgage business. It has always been a good place for real estate. They're not all doing that for me, but I'm not the only one saying that. Alabama cities rank in the top 10, a lot of different ways that you look at affordability and a lot of ways, make real estate attractive. So we have a foreign national product. The reason I ask is we go to 80% on foreign national. All they have to do is have a bank account in the US, a valid passport, and the money to put the 20% down. And they have to put 3 months reserves in the US account, and we close a loan.
Wow.
It is the best foreign national program in the country.
Oh, wow. So you don't have to worry about their credit score and all that.
No credit. We assume their credit score is 680 and we price it accordingly.
Okay. Well, that's cool.
I mean, we literally call it the no loan. We say no to everything. No tax. We don't care about your Canadian income. Because we were talking to Canadians, right? And this is true for any foreign national, Canadian, British, German, Venezuelan, Mexican, it doesn't matter. As long as they're in a country that the US will work with, recognizes this program works. And so if you get anybody looking for real estate that is a foreign national, this is the easiest program to qualify. And we also offer that 10-year interest only loan for them.
So it's any foreign national?
Yes.
With foreign passport?
Yes.
Okay. But I know that, foreign investors are flooding our market now, starting to. Because
and I would say that you should, plan on it getting heavier and a heavier concentration, and plan on that being a bigger sector of business. Here's another place for business. Wiley was saying he's renovating a property and he's not sure if he's going to flip it or keep it. Think about this as a potential market for anybody who's doing this, but Wiley in particular. A lot of these foreign national investors, they don't want to buy the property and renovate it and fix it up. They want you to buy the property, you to renovate it, you to rent it, and you to sell it to them turnkey. And they'll pay a premium for that because our money is safer than their money. And they're looking for long-term investment and long-term return. And when you do the numbers that way, sometimes what you pay for the property isn't as important as what the property yields for you, right? So I think that's going to be a new business too, a booming business going into the next couple of years, doing turnkey deals for out of town and out of country investors, especially when you have lenders like me that are opening up programs to help them get financing, right?
Yeah, I'm sorry. Can I butt in for just a quick second?
Please, yeah.
I kind of tuned in a little late. I had a little technical difficulty, so I don't know if you gave your information out. If we want to try to business with you,
sure. Yeah, I have it here, and I will give it out. Yeah.
Okay.
If you can
definitely.
put it in the chat, yeah.
Yeah, I've got it. Let me see here. What we try to do is get people to use our scheduler to schedule on their time, on your time. So you use our Calendly schedule, and it'll show you available time. And if you want to talk to me, just put for lead, because we have an assistant who goes through it, and if nobody's mentioned, they'll just assign it randomly. So just mention my name, and it won't go to one of our other loan officers. It's just radarlending.com. Everybody is always welcome to pick up the phone and call, and sometimes that's the best way to reach us. But we like to set the time so that we can block out the time. Everybody has important questions, and sometimes if we're doing 4 things at once, we're not giving you full attention. When we schedule this way, we're giving you full attention. And sometimes we may answer the phone and say, hey, let's schedule for another time because I've got 3 things exploding right now, and it's not going to be fair to you. So that's usually how we'd rather work, but we do give you our time. Lending with us, we don't charge application fees. We don't do any of that stuff. The only out-of-pocket cost anybody has doing business with us is the cost of an appraisal, and you don't do that until after you've seen quotes and all that other stuff. That's pretty much it, unless somebody has something else. As you ladies have figured out, if you let me talk, I'll talk. And I've already taken up an hour of your time. So I want to leave everybody with my favorite Zig Ziglar quote: "Don't be a wandering generality, be a meaningful specific." If you're too young to know who Zig is, look him up. Tanya, Manish, I want to thank you so much for your time. I appreciate you inviting me and having me and letting me talk to your friends and connections.
Yeah, well, thank you for coming to our meetup and, for such great information and the valuable information that you gave us. And hopefully we can bring you back again and talk about this more. It's always good to have you on our meetup.